What's up everyone, it's Karthik with MoneyVest. So in today's video, we are going to be talking about the liquidity framework. The inspiration for this video actually came from Michael J at Value Investing, so shout out to him. But this right here is a little bit of an extension to what we have already talked about with respect to cash. And this is an incredibly important concept because the more you understand it, the better off you're going to be over the long term in your investing journey. And we've also been having, a lot of discussion in our Discord with the idea of taking on margin, where the cost of debt can be anywhere between 6 to as much as 10-12%, with the expected rate of return of about 8 to 10%, depending on what you're investing in. If it's the S&P 500, of course, the average return has been over 8 to 10%. So all of that is going to be covered in this video, and I would really appreciate if you share this video with other investors, because I think it's going to be super informative and very helpful in your understanding of long-term investing, right? Especially new investors that are getting started with investing. I feel like this is going to be a gem of a video. So when we talk about liquidity frameworks, we are primarily referring to liquidity as in cash and cash equivalents. It could be physical cash. It could be cash in a checking savings account. And we talk about it in two different perspectives. And that is the expenses, the monthly expenses that you have, and the cash that you have available in your brokerage. So cash that you have available in your savings and cash that you have available in your brokerage are two different types of cash that are going to be utilized in two different types of circumstances. And that's what we're going to discuss in this liquidity framework here in this video. So the power of cash, in my opinion, when there is excess cash, it gives one the peace of mind to hold through times of significant market volatility and uncertainty, i.e., hold for the long term. So if you're watching this video and if you're a long-term investor, anytime you see yourself having excess cash, automatically, it's a psychological thing. It'll give you that excess stability and that excess peace of mind, because even if the markets are coming down, even if there is significant volatility, if there's a lot of uncertainty, we're seeing a pullback, a correction, or dip, or a bear market, anything that might be happening in the markets, that excess cash is going to give you that level of peace of mind that regardless of what happens in the market, I've got very stable levels of cash in my savings and in my portfolio. Also, with excess cash, you get the freedom and the flexibility. In other words, you get the optionality to actually choose from different opportunities, right? It gives you the flexibility to choose where you want to be, what you want to do with your time, depending on how much cash you have. Of course, there's different degrees of the wealth that you can accumulate, but excess cash, excess wealth always gives you that freedom and that optionality between time, career, location, investment opportunities, all that stuff, right? So if you want to switch careers and if you've got plenty of savings, then you're not accustomed to working for your current job, and you can take a break, take some time off, and you can focus on your passions and your other career opportunities. If you want to move to a different location, if you want to be closer to your family, if you want to be moving with your partner, whatever it is with your family, money, excess cash gives you that opportunity, that gives you that option to do that. So excess cash always gives you that optionality to do what you want to actually do with your time, your career, your location, your opportunities that present themselves. So that in itself, in a nutshell, is the power of cash. And the reason why this is so important, and we're actually going to come back to this, because a lot of people actually believe that holding cash is really bad, because there's been a lot of seen disadvantages of holding cash. So some of the more prominent things that you may have heard in the financial media or any of the mentors that you may look up to, they'll tell you that cash is the worst investment to make because it loses value due to inflation. Cash is trash due to its lost opportunity. If it's not invested, there's a significant opportunity cost with it, and cash will not build wealth for you, right? So those are some very key disadvantages that people would highlight by having excess cash. All of them are true. I'm not saying that they're not true. All of them are true. They're in fact very factually correct, because holding a lot of cash is indeed going to lose its value over time because of inflation. As prices continue to go up, there's going to be that loss of purchasing power if you're holding cash. And there's also going to be lost opportunity, because if you're not investing that cash, of course, it's not going to grow, and cash will not allow you to build wealth over time. So all of them are true. However, there are many unseen advantages that nobody talks about of holding cash, right? And again, these are the things that I think are equally important, if not more, if you're holding excess levels of cash. And this is very person to person. And those advantages that could be very unseen are that cash gives you peace of mind. Cash gives you optionality, right? We discussed earlier in the video, cash gives you more freedom. Cash gives you more stability. It's the opportunity cost that we discussed here that's a disadvantage. So cash gives you an opportunity cost because you're not investing that money. But here's the interesting thing. The opportunity cost of holding cash is the opportunity itself. Because if you're holding too much cash, yes, there's an opportunity cost because you're not investing that money. But the cash itself gives you the opportunity to strike when the markets present you that opportunity. Does that make sense? I hope it does, because at the end of the day, like if you are holding excess cash, yes, you're missing out on the market, but it's also giving you the opportunity to invest when the markets give you a significant correction or a bear market or pullback. And I've got some very, very important examples to go over. And one of the most prominent examples are going to be none other than Berkshire Hathaway and the Oracle of Omaha, Warren Buffett himself, whose cash pile just hit a record high of $277 billion. That's almost 30% of his entire sort of portfolio here. And of course, the market cap for Berkshire, I think almost approaching close to $1 trillion, might already be there. I have to check, but $277 billion is a significant portion of his cash pile, and that margin, that level has increased over time. As you can see, that this right here is a significant increase, and it's just gone absolutely parabolic in recent years and quarters, as it's now sitting at well over 200, almost $300 billion worth of cash. And so you might be asking to yourself that, like, why? Like, isn't cash one of the worst investments in the world? Isn't cash, absolutely trash? Isn't there's going to be significant lost opportunity for Warren Buffett? Why is he holding on so much of cash? Well, during shareholder meetings, he has mentioned time and time again that at Berkshire Hathaway, we focus on having plenty of cash at our disposal so that we can take advantage of when the opportunities present themselves, when there is significant opportunity and a risk reward is asymmetric. We are ready to strike at the pitches we like while everyone else is struggling to survive. This has been the words of Warren Buffett over the years, and that's exactly one of the reasons why he's been so careful in having two things: capital preservation, which has led him to have that longevity to remain in the markets long enough to see the benefits of compound interest. So this right here is what he's really been doing. Like, this is what we can regard his success to. So through careful planning and investing, Buffett's success can be regarded to capital preservation, right? So he's always had a non-net leverage position. He's never taken on margin. He's never taken on leverage. In fact, in the book, Morgan Housel's book of The Psychology of Money, he very, very nicely talks about that there's been over 2,000 books that have been written on this man, Warren Buffett. There's over 2,000 books that people have written on Warren Buffett, and every single one of them will tell you what Warren Buffett did, right? What did he exactly do to achieve so much success? But very few books will tell you what Warren Buffett did not do to create a disaster or crisis for himself. So there's two ways to look at things. You can look at the success of somebody and you can try to replicate it in a way that, okay, if that person did XYZ, I'm going to go ahead and do XYZ so I can be successful. But then the other equation is that person also did not do ABC. So if I don't do ABC, I will avoid financial ruin. I will avoid crisis. I will avoid, a situation where I'm forced out of that market, or if I'm margin called, or if I'm just in a very bad position. So it's just been capital preservation and being in the markets long enough so that longevity is allowed him to compound returns over several decades. And, you might be asking yourself, okay, on one hand, Warren Buffett's got a huge cash pile of $277 billion. And on the other hand, he says things like, today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. So here you have Warren Buffett saying or quote something that is completely contradicting to what he's actually doing, okay? And that's where a lot of misunderstanding happens. And I'm here to tell you that both of them are correct in their own ways, because it's all about finding the right balance. It's about finding the right balance. Going all in on the market and having this cash pile down to zero is also not the best strategy. And having ample of cash and having, $1 trillion in cash and only being invested 5% is also not the best strategy. So any of these extremes are not good. So when we are talking about cash, this is a quote guarded more towards an extreme. If people are simply holding on to cash too much and they're just not investing in the markets, that's a terrible investment. That's right. They are going to lose value over time because of inflation. It's a depreciating in value asset. But if you are all in, right, then you're going to get blown out of the game in the next recession or the next bear market, especially if you're taking on margin, and that's it. Like there's no capital preservation there. So it's all about finding the right balance between those two and allowing yourself, putting yourself in a situation where excess cash balance, and this is a nice little flow chart that you can follow along with, excess cash balance creates less emotional reaction to volatility. In other words, you're going to be less prone to doing panic selling or forced selling, especially if you're not taking on any margin, which is going to lead to stronger financial positioning to handle risk, right? So you're going to be in a much better financial position to handle risk, which is going to lead to greater confidence in your ability long term, and especially to hold long term. And that's going to give your portfolio, and it's going to have the ability to let your portfolio and your gains to compound over time by avoiding selling at the wrong times. Oftentimes, we hear about people getting forced out of the market because of margin calls, because the market's dipped, their margin requirements increased, and the brokerage platform liquidated their portfolio, and they were forced out of the market at the very wrong time. That was pretty much at the bottom, and they had to sell, and then the market rips higher, and then they miss out on that entire gain. So this right here is what I have created. By the way, this right here is another reason why I think it's really important to have plentiful in cash, and that is Buffett on Berkshire's $188 billion of cash pile. And he says, and I quote, "We only swing at the pitches we like." So that gives you, again, the flexibility to be very, very selective, gives you the optionality to do what you want at your own time. And that's why excess cash is so important. And the unseen advantages, in my opinion, are equivalent, if not far outweigh, the many seen disadvantages of having a lot of cash. It gives you that peace of mind. It gives you that optionality. It gives you that freedom. It gives you that stability to stay in the market at the best possible times when there is uncertainty, so you can actually invest. So this right here is the liquidity framework that I have created. It's a little bit of an extension to what I saw from Michael J. And it takes into account both the savings and the portfolio, okay? Because there's two different uses of cash, right? So one use of cash is for your monthly expenses, your actual living expense, right? So, your groceries and transportation and your housing and your education, all those things, those are your monthly expenses. That's how much money you need to live every month. And the other cash exposure is your opportunities, right? Things that you can take advantage of when there is actual opportunity in the market. So I've got two different liquidity frameworks that I want to share in this video. The first one is geared very much towards your monthly expenses. So you know how the saying goes that, have 3 to 6 months worth of savings in an emergency fund. That's been quoted by most financial media platforms. It's been quoted by most financial advisors and gurus out there. That you have 3 to 6 months worth of savings in an emergency fund. I say that 3 to 6 months is still not enough. I think it's a little bit more important to target for at least 1 year worth of expenses, because that will give you plenty of time to figure things out if there were to be any situation where you lose your job, right? So if there's any issues with you getting laid off, for example, if there's an unfortunate event at your job, at least you've got plenty of cash to figure things out. If you need to relocate, if you need to have more time, if you need to switch careers, whatever that might be, I think 12 to 24 months is a level where you can feel a lot more comfortable in your position. So first things first, if you are at a level in your life where you have absolutely 0 months worth of savings in your emergency fund, I think that should be priority number 1. So in this example, if you've got 0 months of savings in your emergency fund, I think that should be priority number 1, where you drop everything that you're doing, all investing, drop that, just save 1 month worth of expenses to get to at least that minimum level, right? That's the minimum level where you have at least 1 month worth of savings in liquid cash. That's your monthly expenses. If you've got 3 months, then that is limited. If you've got 6 months, then that is sufficient. That's what most people say, 3 to 6 months, it's limited to sufficient. But in order to feel secure, in my opinion, I think you need at least 12 months worth of monthly expenses saved up. 24 months is going to put you in a very, very robust situation. So you've got 2 years worth of monthly expenses locked up in a high yielding savings account. Super liquid, does not really have to deal with market volatility, and anything over 36 months, which is 3 years, gives you plenty of optionality and freedom, and that is a very excellent position to be in. So kind of go through this framework and figure it out for yourself. Look at your savings account, checkings account, liquid cash, and see what your monthly expenses are to then figure out, okay, how many months can I cover myself if there's any unforeseen event? If I lose my job, if anything were to happen, if you were to relocate, if you were to have more time to figure things out, how many months can I go by without having a job, without having an income, right? So figure that out, and the longer the better, right? Now, of course, don't let this number get to crazy levels here, like, 5 years worth of expenses or 10 years worth of expenses, because then, you're obviously missing out. There's a huge opportunity cost to that as well. So don't overdo it, right? That's the whole idea. It's just everything has a balance. We're not operating under this extreme where we have nothing in emergency, but we're also not operating under the other extreme, where we have a lot of emergency funds where we're not even investing, right? So you want to find a happy medium. And for me, that's anywhere between 12 to as many as 36 months. 36 might still be a little bit on the higher end for many people out there. But 12 to 24 months, I think it should be the ideal. Secure to robust is what many people should be targeting when it comes to liquid cash that's available to them as part of their monthly expenses. So now we move over to the second part, which is the cash that you keep in your brokerage account. That's your money market funds that's at your disposal to take advantage of opportunities for investing. It could be stocks, real estate, gold, Bitcoin, anything there might be that you find opportunities in, and you keep cash around to take advantage. So I've got the negative 0% here because many people might also be investing and trading using margin. And for me, I think margin is a very, very subjective area. If you know exactly what you're doing, I think that's okay. But if you are using margin for the first time and you don't understand how margin works, because margin is one of the highest interest rate debts that you can have, right? When it comes to portfolios and investing. So I'm going to put that under distressed. Only reason because if you're using margin, I'm assuming you don't have any cash available in your brokerage. You've exhausted all your buying power, and then you're taking on more. You're borrowing more from the broker to invest further. So you've got negative cash balance in your portfolio. So that's going to put you in a bit of a distressed situation because, like I said, if markets drop 10, 20, 30%, your account is going to be very vulnerable to getting liquidated based on a margin call, right? So you're going to be forced out of that market if you are on too much margin. So if you understand what you're doing with margin, if you're experienced, but this video is not for experienced investor, this is for beginners and also mid-experience investor to better understand where you can be in your liquidity framework. So if you're using margin, and especially if your cost of margin is higher than your expected return, that makes it even more difficult. And we were having this conversation in our Discord as well. One of our members was talking about how they can take on margin at about 6 to 8%, and they can expect to make about 8 to 10% from the market. The interesting thing with that is that there's two things. Number one, you have to understand the rate differential. What are you paying for your margin in terms of cost, whether at 6%, 8%, 10%, what's the cost of interest with the expected rate of return from the market. So that's the rate differential. And that number needs to be positive in order for it to make sense. If you're borrowing money at 10% and you're making 5% on that investment, that doesn't make any sense because you'll be losing 5% interest every single year. So your cost of borrowing needs to be low and your expected rate of return needs to be high. Another thing that we have to discuss, and that could be for another video, is the expected rate of return. What is the probability of that high rate of return? Is it really high or is it really low? Because your debt is fixed. The brokerage is going to charge you, the bank is going to charge you 5%, 6%, 8%, whatever that interest rate is, fixed every single year. That doesn't change. You have to pay that interest on your margin. But the expected rate of return will fluctuate. It's not 8% every single year, right? It could be 4% one year, it could be 20% the next year, it could be negative one year. So it's going to fluctuate. So your expected rate of return is uncertain, but your debt is fixed. So that also is something that you have to account for if you're using margin. I have never used margin. I don't like to use margin. I don't like to put myself in a distressed situation where I'm pretty much all in and I'm taking on more money to invest even more into the market. That just doesn't give me that peace of mind that I need. So if you've got cash between 0 and 5%, that still puts you in a bit of a vulnerable situation because you've got less than 5% cash available and you are 95% invested in the market. 97% invested in the market, 98%, whatever it might be. Still okay. I mean, but that still does put you in a bit of a vulnerable situation, because if the markets were to dip and drop further, or any asset class that you have a greater understanding of, like say that you want to buy real estate, or you want to buy gold, you want to buy Bitcoin, you won't be able to take advantage because you're already 97, 98% invested in the market. 5 to 10% puts you in a bit of a cautious zone. I think that's okay. I think having 10% cash is still very cautious and very reasonable. 10 to 20% puts you in a bit of a defensive state. So I think 10 to 20% is ideal. It's going to put you in a bit of a more defensive state. And I think I do fluctuate somewhere between cautious and opportunistic. So I'm going to go over that now. So prepared is 20 to 30% cash, and this is in your brokerage account. So if you've got $1 million you're investing with, 20% of that, that's $200,000 in cash. You're prepared for market pullbacks, corrections, bear markets, or even better opportunities for individual stocks that you may want to invest in. And 30 to 50% is opportunistic, and over 50% now puts you in a bit of an underinvested state. So that's why I mentioned that any extreme is also not good. If you're taking on too much margin and you've got no money left to invest, that puts you in a distressed situation. But if you have over 50% of cash available, that puts you in a bit of a state of underinvested, right? Because then you're actually going to miss out on opportunities here. It's not an opportunistic zone to be in, rather it actually serves an opportunity cost. So it's really important to find a balance between those two, and of course to be somewhere between here. So my goal really always has been to be somewhere between the cautious to opportunistic zone. Ideally, I mean, my cash fluctuates between 5 to as much as 30%, given the level of the market and where we are, and if what kind of opportunities I'm seeing in the market. More recently, I've been as much as prepared. So during this market pullback and correction, I was very much prepared, somewhere between 20 and 30% cash, and then I deployed that, and I think I've moved back into the defensive category now, where markets are starting to recover back higher. But if they do continue to drop further, I'm going to be ready to deploy more cash here once again. So that's the liquidity framework. Figure that out for yourself. I think a combination of these two is what's going to really dictate how successful you are on a personal finance on a long-term basis. In my opinion, having somewhere between 12 to 24 months worth of monthly expenses in savings, and also having anywhere between 5 to 30% cash available in your brokerage platform gives me that peace of mind, gives me that stability, gives me that sense of optionality, and doesn't put me in a situation where I have to freak out every time the markets sell off. So hopefully this was helpful. Again, it's going to be subjective. Everyone's going to have a different overview on this. So let me know your thoughts down in the comment section below. And how do you feel about this? As always, if you enjoyed it, found it helpful, make sure that you drop a like, subscribe to the channel, and share this video with another investor or a friend that can benefit from this. As always, happy investing. I'll see you all in the next video.